Hey, MCE crew, I want to talk to you about 3 financial institutions and the way that I've used those financial institutions on the road to financial independence. Before we get to that, go ahead, like, subscribe, share. Help me out with the algorithm. If you have subscribed, I thank you. It's incredible. Also, I want to say something here. There are a lot of people out there who are losing their jobs for reasons that we may all be well aware of. If you are looking to change careers, if you are entrepreneurial and want to start a business, as I've said many times on this channel before, the businesses that my family have been in for decades now, real estate and financial services, we serve clients, but what we also do is we show people how to build those businesses in those industries, and we don't charge you for it. Okay. And I hate to say that because sometimes people say, if you're not charging me, it doesn't have value. Okay. Please don't think that with this. We're showing you how to create businesses. That's one of the things that we do. And we've got a hell of a track record of success. Okay. So if you want to contact us, if you know someone, if you personally want to start a business, hit us up on our Facebook page. We've got the link in the description of this video. Or you can also go to our website, which is also in the description, mcenow.com, and send us a message and let us know. Again, if you or someone you know has lost their job or is thinking about a career change and wants to get into or just get more information about what we do here, go ahead and contact us and we'd be happy to talk to you. There's no obligation. We're just giving out information. All right. So these 3 financial institutions, what am I talking about? Well, the first one is a bank. All right. How do I use a bank? Well, I can tell you right now, I've changed kind of my modus operandi with the banks, and I'm only using banks for 2 things, loan or credit line products and checking. Okay. That's it. No savings, because with inflation where it is, I mean, we've been over 5% now for the better part of a year. And your interest on a savings account in the bank, even if you've just got it sitting there for emergency purposes, it's far less than 0.5%. So in most cases, you can get up to 0.5% with some online banks, but that's still a losing equation when we look at the rate of inflation. So even if you just got money over there parked and it's just there for emergency purposes, it is losing value if you're keeping it in a bank. And the bank is turning around. They're giving you, less than 0.5%, less than 0.5 percentage point they're giving you. And then they're turning around and they're loaning that money out for 4, 5, and 6%. And if they're loaning it out on the basis of a credit card, it's upwards of 16% in many cases. So that doesn't work for me. So what does work for me is using other people's money as leverage. I don't mind using the bank's money with regard to lines of credit or mortgage loans. Okay, if we're trying to make an investment in property or we're trying to invest in our own business, the line of credit for the business in order to leverage, okay, other people's money, in this case, the bank's money, not mine. I don't have to put my money up, take it out of play where it is earning a great return and, put it into a situation where I've got to put it into play for my business. I can use the bank's money for that. And that's what I'm using a bank for. And the bank still has the money that, I have in checking. And that's fine. They can still play the fractional reserve game with that. And what I mean by that is banks, let's just give you a really broad example here. Fractional reserve means that if you put $10 in the bank, the government gives the bank the the Federal Reserve actually gives the bank the permission to loan out at, let's say, 10 times that. So for every $10 that you deposit in the bank then has the ability to loan out $100. It's called fractional reserving. They can do it on a checking account as well, and that's fine. I need to move money around in checking to do certain things, and so I can use the bank for that. I can use the bank for their credit products, but I will not use a bank and think that I'm going to actually make money by having a deposit product. Now, maybe I can invest in a bank, that's a different equation. But I won't use deposit products, savings products, CDs, anything like that, because you're losing money. So it doesn't make any sense. Remember Warren Buffett's first rule, don't lose money. And Warren Buffett's second rule is don't forget rule number 1. What is the second financial institution that I use? Well, it's probably quite obvious to you. It's a brokerage, okay? A brokerage where I can invest in other companies. Because I own companies that belong to, me and my family, but I want to invest also in other companies where I don't have a management role, where I can just enjoy the success of the company by investing in them on the stock market. So that's where brokerage comes in. Very simple, okay? I do not use margin accounts because I'm a long-term investor, and I'm comfortable without having to use a margin account. A margin account, basically, we've been over this before, is where you can borrow against the value of the shares that you hold in order to buy more. Okay, and you can use the shares that you own as collateral. I don't do that. I'm not saying that it's a bad idea. It's just not one I employ. So I borrow from a bank. I use a bank for checking purposes. And when I want to invest in companies other than the ones that I have an ownership stake in, or ownership and a management stake in, then I go to a brokerage. Now, what is the third financial institution that I deal with? Insurance companies. Insurance companies are actually where I put money for savings. A lot of people don't understand that. A lot of people, you'll hear some of these so-called financial gurus out here that are on TV and got big contracts with the big networks, poo-poo the idea of insurance as a financial vehicle. Let me tell you something. Term insurance has its place. That's where you pay a little bit of money for coverage, a lot of coverage, okay? The reason why it's like that is because term rarely pays out, because the term runs out. Most people live to a ripe old age. They outlive the term insurance. And I'm not saying the term insurance is a bad idea. I have a term product right now because it helps you to, set your family up, rent your wealth, so to speak, okay, until everything that you're doing catches up with the value of that policy, the benefit of that policy. But what I really use insurance for is permanent insurance policies, permanent life insurance policies that allow me to put money into that policy, and I get to borrow it from myself. I don't have to pay any taxes on it. Once I put it in there, I can borrow against it tax-free. That money does not have any types of restrictions on it where I've got to be a certain age or anything like that, okay? And then the other thing, the money grows tax-free. I already said I can access it tax-free. And when I eventually pass away, that money will transfer tax-free to my heirs, okay? So that's where I put money to grow. I now also like putting money in insurance policies and having it grow because taxes are going up. And the money I put into the insurance policies is after I've already paid taxes on it. So it grows tax-free. I can access it tax-free. And as you know, look, we're spending trillions of dollars. The tax situation is only going one way, and that's up. So I want to have liquidity, which that gives me just like it would in a savings account. But I want to avoid the taxation, okay? I want to avoid the complexities. And then a lot of people, you'll hear them say, well, insurance is just so expensive. You know, there is a cost to insurance because in addition to all the benefits I just mentioned, you also get to have a death benefit so that if you pass away, or when you pass away, it's going to happen to us all, your family gets money. Okay. Now, if I took out an insurance policy tomorrow, and then God forbid something, and it got approved for, let's say, 100 grand, okay, and something happened to me next week, and I'm not here anymore, well, then the insurance company they take an L on that, okay? That's why up front, there's a cost of insurance. And the insurance company, in exchange for them making you a commitment, a promise to pay out all this money to your family, they have, charged you a premium, a cost of insurance up front. I love it. It works out perfect for me. So that is how I use those 3 financial institutions to propel my financial independence. Banks are for borrowing. They're not for saving. Borrowing from, or, using a checking account function. Brokerage companies are for investing with. And insurance companies are for generating tax-advantaged liquid savings, okay? There are a bunch of configurations with these permanent policies. You can have indexing. You can have one that's with a mutual company and pays you a dividend. There are a lot of different configurations, but in the end, those benefits that I mentioned are static, okay? They exist across all the different configurations of whole life, permanent life insurance. All right, guys, I'll talk to you soon.